Alrighty, good morning, everybody. Hope everyone's having a great Wednesday. Welcome to South Florida Business and Wealth's virtual CEO Connect, reopening, the reopening and the impact on the financial markets. My name is Clayton Idle, and I'm the Managing Director of South Florida Business and Wealth. And I'd like to start by thanking everyone for joining for our virtual Connect today. I do see a lot of familiar names on the webinar, but if you don't know who we are and what we do, we help connect you to the top area executives in South Florida. We do that several different ways. Most people do know us by our publication that goes out every single month to over 25,000 CEOs and other executives and business owners. We have a whole suite of digital products to complement our print, like a daily e-newsletter that goes out to over 40,000 executives and business owners in the Tri-County, South Florida area. And as soon as it's safe, we are excited to get our event platform back up and running, which will hopefully be sooner than later, right, Kev?
Yes, sir.
So enough about us, but if you are interested in receiving our publication, our daily e-newsletter, or just want to learn a little bit more about our different platforms, we will follow up with an email and how to get a hold of us. It's a couple housekeeping things. If you'd like to submit questions, which we highly encourage you to submit questions, we do want to make this interactive today. Use the Q&A feature down at the bottom of your screen, and Kevin will start to get to those during the interview, and he'll probably hold some for the end of the interview as well. We'll also be sending out a short survey after the event is complete. Please fill it out, and it helps us so we can make our events even better for you. Now, let's get on to our main event here. I'd like to start by introducing and reading the bio of the interviewee, Mr. Mason Williams. Joining us today is Mason Williams, Managing Director and CIO of Coral Gables Trust. Mason Williams has more than 18 years experience building investment strategies and managing institutional multi-asset class portfolios for high net worth private clients, families, and foundations. Mason's recent experience has been in South Florida as the Chief Investment Officer for a trust and wealth management division for a well-known community bank. In his capacity there, Mason chaired the Asset Management Committee, which handled implementing portfolio strategy and allocation. Mason specializes in customizing portfolio solutions for high net worth individuals and families by using an open architecture framework. Having a career fully dedicated to fiduciary investment services, Mason has extensive knowledge and experience in trust administration, compliance, and business development. His academic training is in finance with a master's degree from the University of Miami. I'm sure we have some Canes fans on here today. And a BS from Arizona State University. Mason is an avid golfer and has been involved with charitable organizations such as the Cystic Fibrosis Foundation and the Susan G. Komen Foundation. Thank you all for taking the time to join our panel. I would now like to pass our virtual microphone over to our Editor-in-Chief, Kevin Gale, for the interview portion. Kevin, take it away, my friend.
All right, Clayton, thank you so much. Mason, great to have you on today. Cindy, thank you so much for helping set this up. And Olivia is our Events and Marketing Director who does a lot of work behind the scenes on this. So thank you too. So let's just get to it. So Mason, take us through how the markets have reacted since the all-time highs in February through today.
Yeah, Kevin, thanks for having me, guys. Appreciate this, and welcome everybody. So yeah, Kevin, it's been a wild ride, for sure. I mean, it was smooth sailing last year. Investors didn't really have to do a whole lot last year to hit strong returns on their portfolios, and that continued into January and somewhat most of February. And then the news of the pandemic came out, the virus spread came out. And that tended to, it started making people nervous, right? It started abroad, of course, in China. That's where it started. And of course, we didn't really take it seriously until it made its way over here. And then it really started to spread around. And that was about late February, early March, right? And then the market started reacting to that. So yeah, we did hit all-time highs. And then the market, in a matter of just a few weeks, had the quickest stock market correction we've ever seen in history, really. We went from all-time highs down to 20% in a matter of days, and then eventually reached, 30 or so percent down from the highs of February down to March 23rd. And that's kind of where the bottom settled in, given recent history. So And then since March 23rd to now, it's been smooth sailing, pretty much an uninterrupted up move. And that's on the back of a lot of different things that happened back in that March period to get this thing turned around.
A lot of money from the Fed helping us out here. What are some of the sectors or industries that you've sort of observed? Maybe some doing better, maybe some not doing so good, and at different times too.
Yeah, right, exactly. Well, initially, right away, was travel, leisure, hospitality. Restaurants, cruise lines, airlines. They all dropped, big time, and for good reason, right? We were told to stay home, not go anywhere, and the world shut down. So nobody's going to get on a plane, nobody's going to get on a cruise ship, and people aren't going to go out to eat. So really, everything really fell. I mean, it was for a while there was no place to hide. Okay.
Mm-hmm.
But the areas that I guess would say relatively held up better were the areas of large cap tech, big balance sheet companies that don't really depend on the hospitality sector to make their numbers, right? So, and then the financial media started building this story and this dialogue around stay-at-home stocks, okay, stay-at-home companies and industries. Just think of Amazon, think of Facebook, think of Etsy, Wayfair, names like that they fell, but they really came back harder. And overall, you stretch it out over that period of time, they probably did better than the rest. But travel and leisure, anything cyclical, like banks had a hard time. They're still having a hard time. Energy sold off. We saw negative oil trade for a while back there for a week or so because things were so discombobulated. And energy and financials, funny enough, have actually done better recently. But really, it was the large mega cap tech area that did the best, okay? And it was the travel, leisure, and hospitality areas that did the worst, okay? And then you can get a little bit more granular. Small cap, mid cap did not fare well at all because they're more economically sensitive and more dependent on a stronger economy. So there's other pockets that didn't do well as well. So, but rising tide lifts all boats. From March 23rd to now, large cap tech let us out of this hole we were in, okay? But recently the tides turned over the last couple of weeks where value and more cyclical names have actually kind of rotated back into favor. So back and forth among different constituents.
Yeah, it sometimes seems like you wait a day or two and there's a different theme that comes out if you listen to CNBC or something like that. It's like, okay, what's on the menu today at the restaurant?
Right. Well, you kind of look at your two markets. You look at your stay-at-home markets, and then you look at your per se reopening markets, right, or reopening sectors, and you can kind of gauge what the market's thinking by just looking at a handful of stocks in either bucket.
Yeah.
Okay. So, when you see the exercise bike company Peloton, right? I'm not sure if I'm saying that right, but that company, or Facebook or Amazon, if they're having a hard week or a hard time, well, maybe the market's thinking, okay. It's trying to sniff out something on the recovery side down the road that warrants those names to perform a little bit more better. So, yeah.
I was fortunate. I bought Peloton last year when I actually bought one of the exercise bikes. Right. So you're right, very volatile. So some days it zooms up, other days it's down. Talk a little bit about fixed income and bond performance. Where are we at these days on that?
Okay, so bonds, again, were funny enough not immune either back then. When the sell-off sort of had two legs from the February highs and into March 23rd, bonds were doing their job in the first part of that sell-off where they were offsetting the equity decline, okay, like they should do. And then it kicked into another gear, and this I want to say maybe March 10th through March 23rd, bonds sold off too. There was no place to hide. Okay, even the highest quality bonds sold off, and that was due to illiquidity. Okay, so the market dried up. Okay, and that's when the Fed came in with both hands and came to the rescue and threw all this money at the system to get the engine going again. And that's exactly what happened. So before they came in to help, spreads widened, which happens in fixed income. People sold out because there was a desperation for cash. Anything to get me into cash, even the best of the best, sell me. I went out. Right? The Fed came in, it started a bunch of programs, bought bonds themselves, okay, and have started to reinflate the balance sheet of the Federal Reserve. And that started to grease the wheels, per se, again, where the credit markets started to behave more normal. So there was a or 8-day window there where if you were a bond buyer, particularly in the municipal bond world, the tax-free bond world, you got some deals that you'll probably never see again, just because there was no buyers and sellers. Spreads widened. And if you were on the buy side, you could pick away at some very good deals for a moment in time there that, looking at your gains now, back when you bought, have been extraordinary. So there was opportunity even in the bond market there for people with, I guess the stomach to do it, and come out and purchase some fixed income. And you didn't even have to go out that long. You can go 5-year paper and get a heck of a deal and a heck of a yield, just because the market delivered a gift as far as the liquidity. But it's hard to do. But now that market's behaved, rates have dropped. You see the 10-year treasury at 0.8, or take 0.75, 0.8, and the 2-year treasury and the stuff on the shorter end's even worse. So it's all been, that market's healed. But now if you're a new investor trying to go in and get income, it's even harder.
Yeah.
It's even harder.
Yeah. Any thoughts on the corporate bond market these days and where you're seeing strength, weakness? That can be a very speculative market at times if you're into the high yield market. What are your sort of thoughts? And what does the corporate market for debt say sort of about where we're at in the economic recovery and fears and all that?
Well, the bond market itself, just look at the treasury curve, and of course the high yield and the corporate bond market have a spread over that, right? So rates are low across the spectrum. Since the Fed has come in, corporations have now been more willing to issue debt. And I think we're somewhere between $800 billion to almost $1 trillion in corporate debt being announced or raised just in the last 2 months here because of what the Fed has done, taking the opportunity to lock in rates, at lower prices, which, you could argue, well, we're already over leveraged, but, corporations hopefully are managing it correctly. But it's an opportune time. If you want to raise capital, the markets are giving it to you. We would advocate for staying higher in quality in the corporate bond market, stay in the A-rated range, maybe upper triple Bs, but that's it. Anything below that is subject to possible downgrades if your business doesn't pan out and it weakens. And then the high yield market's a whole other spectrum where, yes, it deserves a piece in a portfolio, but we wouldn't really recommend overweighting it entirely because it is volatile. The yield's good, but, the companies within it can be under stress. And look at energy. That's one of them. When this is all over, some of the smaller and mid-play oil companies are going to have a hard time making it through this, and their debt's going to suffer. So you got to stay higher in quality.
It's sort of interesting. The last Zoom webinar I did was with Jeff Stoops of SBA Communications, which is an S&P 500 company, and he said they had a huge issuance. I could be wrong on this, but I believe he said 400 million. And he said, well, we don't really need it right now, but with the uncertainty. So you've seen some of the investment grade companies just, like, hey, let's just have some dry powder here. So
Yeah.
It's interesting to see what's happened with some companies, and some of the big companies can get incredibly good rates. So
for sure. And if you're just in the market trying to buy general corporate debt that's A-rated or better, the yields you're getting for those purchases are barely above treasuries. So that's a signal that the market is healed. There's not big wide spreads over treasuries, so they're relatively compact, and that is a signal that the market's healed, but low rates signal weak growth right ahead. So,
yeah.
It's a give and take. It's a give and take. If you need the money, it's cheap, but if you're looking for income, it's not so great.
So tell me about your experience dealing with your clients. Some of us have been through a lot of ups and downs over the years. How did your clients react, and what sort of guidance did you give them? Did you give them any advice on changing the mix of their portfolio, for example?
Yeah, well, we try to do a lot of, not really, and this is why. We try to do a lot of homework in the beginning of onboarding a client, to where we try to feel out their situation, ask a lot of questions. What's the risk tolerance? What's the income needs? What's your time horizon for the money? Do you have any short-term goals you want to accomplish with this money, or what have you? And eventually try to put them into a portfolio that makes sense for all those answers that they gave us. When the market it's the nature of the beast. The market's going to sell off here and there. That's just what the markets do. The market, it's not out of the ordinary for a market to have a 10% correction twice a year. It's not out of the ordinary. Of course, we got the extreme version of that times 3, right? We it was
Yeah.
pretty extreme, but even if you're in the right portfolio for the long term, you shouldn't have that urge to jump ship, okay? And it's dangerous if you do. It may feel good in the short term just because things aren't going your way, but if you abandon a perfectly good portfolio built for your long term and your financial plan, well, then you got bigger challenges ahead trying to get back in and reconstruct that, okay? If you look at history, some of the biggest days you can ever experience in a market are sort of those first 10 or 20 days that you experience coming out of a major downturn.
Yep.
If you are present and invested in those 10 or 20 days, and then you go 5 years further, your annualized return is going to be far less than it would be if you just would have stayed still. Okay. So, we did some minor allocation changes based on the client's kind of comfort level of what was happening. But all in all, we tried to keep them steady and just reassure them, look, this is what we see. This is why we're built this way. And, we do recommend you staying pat. And now, of course, if a financial emergency came up or something really warranted a change, then you got to act. Okay, there's no question. But, if the financial situation or the plan did not change materially, it's wise to stay put.
Yeah. Did as when the downslide picked up with intensity, did you get a lot of calls or anything?
Sure. Yeah, we had our fair share. Sure. And which is, expected. And we tried to get out with newsletters on our thinking, and it's human nature to reach out, right, and feel what's going on. It was a very, no doubt, it was a very uncomfortable situation. And we were here to help. So, and that's what we're built for is to keep people sort of calm and sane during those crazy times, because they are very uncomfortable. But staying still and not doing anything was the right thing to do. If you look back, I mean, if you bailed out and went to cash or really drastically reduced your equity exposure, it's hard to play catch up now. It's really hard. It's a different commitment, So, but I think our firm, we did a very good job of staying ahead, being proactive, and letting people know our thoughts.
Yeah, I think timing the market can be sort of a fool's errand in my experience. Talk about some of the government programs that were put in place to help cushion the decline.
Well, the first, the CARES Act was the first go around on the fiscal side from Congress. That was 2.2 trillion in size. That was signed on March 27th, and this is what I meant by the first wave of help coming through right around the market lows. And March lows were, 323, March 23rd, and they signed, I believe, the CARES Act on 327. So there you go, 4 days apart. Okay. And so that had a bunch of programs in it to help small businesses. Of course, the $1,200 stimulus, checks going out to mailboxes, plus more if you have kids and full-blown families. So that all helped. That it was, of course, it was put together in a couple of weeks, so it had its problems. People were getting checks twice, and checks were going to places they shouldn't have. So it had some glitches, but it worked. And at least it was enough to keep us from going down further. So that really, I would say, got fully engaged around late April. Because there was some hiccups, but it finally got it implemented. And then the Fed behind the scenes was the other thing that was going on. They again reinitiated all their QE programs from the crisis era of 08, 09. Okay. Literally dusted off the playbook and then leveraged that times 3. I mean, they threw amounts at this that we've never seen before. Bond buying programs, which again is a way for the bond to go in, for the Fed to go in to the marketplace and buy bonds to keep everything fluid. Okay. To increase liquidity into the system. So they expanded that to municipal bonds, which they've never done before. They expanded that to corporate bonds, which they really haven't done before. And they also extended that to bond ETFs, which they've never really done before, exchange traded funds. Okay. So for a point there, the amounts that they would buy per week were going up and up and up to increase the liquidity. And that's when the spreads started to contract to get back to normal. Now they've dialed off of that a little bit. They're still active in the market, but not as severely as they were before. Okay. But on the fiscal side, Congress is kicking around another package. Okay. Because the unemployment insurance benefits, they end here in a month or so. I think it's July 31st. That's going to go away, where that $600 extra per week is going to vaporize. So they're going to have to make a decision on that. Are they going to extend it? Are they going to do something different to wean people off that and come back to work if their employer is still viable and active? So more to come there. And the Fed is meeting today, actually, as we speak. And this is the first press conference from Chairman Powell since March. So it's going to be interesting to see what his thoughts are on on the future. So we don't expect a whole lot, but this is his chance to open up on maybe what they might do next. But I don't expect a whole lot of detail because it's still a very sensitive time.
So we do have a couple of attendees who are asking Fed questions. I don't know if you can go much beyond what you've already said. One question was, how long can the Fed continue to boost the markets? And the other question, that was anonymous, the other one from Bradford Shupp. Thank you, Bradford, for your question. Do you see the Fed needing to push more money into the economy over the next year? Any guess on how much? 1 trillion, 2 trillion, more?
I don't know the amount, but it's going to have a lot of zeros behind it. I can tell you that. It's you know, the Fed. If you look at 08, 09 and kind of look how slow they were. Okay, so they in 08, 09, you know, they were sort of they didn't get really active until well into 08. Okay, and then 09 they finally got really serious about what was going on. Past that, the $700 billion act back then to get things going. Well, and they were at zero interest rates too. Okay, back then too. So they didn't raise rates until 2015. All right. So you're looking at 6 years before they even pulled anything back. And the economic situation, or especially the employment situation, wasn't as dire back then as it is now. So if you kind of extrapolate what happened back then, I mean, our best guess here as a committee and our investment think tank thinks that they're not going to pull back anytime soon. So if anything, they're going to keep feeding the system. Okay. So between now and when they could start pulling back, who knows? We think it's years away. Okay. This thing, I mean, we're at 13% unemployment, and it's kind of strange how last week we're kind of cheering about that. It's not a good thing, but the market liked it because it didn't get worse. But we were at 3.7, 3.6%, give or take, unemployment rate. Now we're at 13.3. Right. We got 10% to go, and it's not going to happen overnight. So the long-winded answer to that question is yes. The Fed's going to stick around, many more billions in various programs, and they have, you know, I think they have an opportunity to take a breather now, and wait and see what happens from the fiscal side, and then if they need to get active again, they certainly will, because we know they can do it, and we've seen it work.
So why exactly is that part of the reasons the markets have rebounded so hard since March 23rd? And has this been surprising given what normally happens historically?
The velocity has been surprising for sure, and the speed and the scale has been surprising. And this is what happens when liquidity comes into the system, right? The whole point of the Fed coming in is to lower interest rates. That's their goal, to make money cheap. And what it does is it gets investors and big money to get anxious and not sit in low yielding, low risk vehicles. You know, the whole point is to get out there and borrow. You know, if you're a borrower, take the opportunity to refinance your mortgage. If you're looking for a house, get a mortgage. You know, there's great auto deals out there, you know, financing 0% APR for 5 years, 6 years, whatever it may be. So if you're a borrower, it makes you think, maybe I should get out there and do something for my business or meet myself on the personal side. And then from the investment side, it's hard to pay a lot of bills on a 10-year treasury paying 0.75. It just really is. So it starts to change the psychology of risk taking. Okay. So eventually you're going to come out of your money market and your bank accounts and your short-term bonds, and maybe extend out to equities and other parts of the bond market to take a little more risk to get a little more income. And that just all starts to have a snowball effect. Okay. And the markets sense that, and the buyers come in, and then off you go. And that's exactly what we've seen. Okay. I mean, 47% is a rocket ship. It really is. I mean, I've been at this for 18 to 20 years, and I've seen snapbacks, but you know, nothing to this magnitude. So it's been quite fascinating.
Yeah, me too. I've been through a lot. So you get into what kind of recovery can we expect now? You hear U's, you hear V's, you hear
Yeah.
L's. So what shape do you think this will take, and could it be a
Yeah.
little more jagged or something?
Well, I mean, look at the stock market. I think you got the V covered. I think you got that covered for sure and beyond. So far, I mean, not to say that we can give a little back here because the market's come so far so fast, but which I think would be welcome. But it, that's definitely a V. Now you got the economy. What letter would that look like if you had to put a letter on it? Well, we hope it's not a W. We hope it's not a W. I think we've kind of defined that first part of the W coming back up, but the whole part that could put us back down is the second wave of the COVID-19 in the fall. The reopening's not going as well as we'd hoped, and those things kind of converging in the fall when winter comes back around. But as I was saying, the jobs number last week was very strong, relatively speaking, versus what we were predicting. If we get a couple more months like that, to where maybe a trend is starting to define itself, then you can maybe look at a U there. I wouldn't say a V, but maybe a U starting to form where the bottom of that U is not going sideways. It's starting to maybe curve up a little bit. But to get to the top of the other side of that U might take, a good couple of years, maybe more. It depends. It's all dependent upon unemployment's huge. I don't think we have an inflation problem. We're actually fighting a deflation problem right now. So inflation isn't an issue right now, at least in the short term. And if again, unemployment, and then if we avoid a second wave of COVID or we get a vaccine, 12 months down the road, that's a huge game changer, and things could fire back on the economic front, Main Street front, much faster and catch up with the markets. So there's a little bit of disagreement here with what us on Main Street see versus what investors in the market are actually experiencing.
Yes, I think you got that exactly right. I want to come back to fixed income just a little bit. You had mentioned that what's happened with rates and things like that. So how are you structuring portfolios now to generate income? What areas do you think you have the best potential, and can dividends play a role in that too?
They do, yeah. On the bond side, it's bonds they're not that attractive. It's hard to look at those yields and get excited about them, but they do still serve a purpose. In the balanced portfolios that we build for clients, for the most part, say you take a 50-50 investor, 60-40 investor, well, that 50 or 40% have to go to fixed income. How do you do that? Well, if you're of the mindset that rates are gonna go lower from here, well, then you lock in. You just try to get what you can, okay? But if you think rates might even get a little help here and go up, okay, you want to be rather short. You don't want to go out too far, because the longer you are, if rates got away from us, say we get a vaccine, the economy recovers quicker than we all expect, well, rates will come up, okay, just because on the nature of growth, right, for a growth outlook improving. So it's going to really depend in the next couple of years which way that goes. But you can do treasuries, you can do government agencies. If you're in a very high tax bracket, you can do municipal bonds, corporate bonds like we've talked about, and you can do a little high yield and even preferred stock. Preferred stock are the hybrid instrument between bonds and equities, where they have coupon and they kind of float around a NAV price that's usually $25 in par value. But it's sort of in the corporate hierarchy, it sits below secured debt, but above equity. So your dividend in that instrument is pretty secure, but it pays way more than a highly rated corporate bond would. So we recommend blending all of those components, okay, because they're not all going to behave at the same time in the same way. So if you blend that component mix and you get a blended yield that's, a rate above treasuries that's reasonable and decent, that's all you can really do at this time. And what you don't want to do is walk out on the risk curve and get slammed if things don't go our way or a second wave comes or whatever, because then you're going to really feel price pressure on those investments. And that's the whole point of fixed income, is to have that sleep at night part of your portfolio. Maybe not doing a whole lot and it's not that exciting, but it will hopefully protect you if the markets were to still have a very difficult time.
I saw an article on Barron's recently about convertibles. I don't know if you saw that or not. Do you use convertibles at all in your approach to investing?
Yeah, we really haven't gone that route. We're more traditional into the corporate investment grade market, straight up A-rated paper or better. We do have high yield in the portfolio, but it's like the highest rated high yield, very very top of that spectrum. So we don't go even further into the triple C or the double D market at all. That's just you're asking for trouble by doing that. So we really try to stay up in quality in the high yield market. But our blended portfolios have a pretty good yield right now on the fixed income side. I mean, it's north of 2.5, close to 3, and that's because we're getting help from preferreds and high yield. But the duration of our portfolios are shorter than the indices because we want to stay a little bit shorter. We're getting good yield. We're outperforming treasuries, but we want to be mindful of rates going higher, and we don't want to be too far out in duration if that happens.
Gotcha. So are new clients apprehensive about putting money to work and committing to a long-term plan?
It's a good question. Believe it or not really. Not really. You would be surprised. The mentality's been the other way. The questions have been more like, should we get in? Is this a good time? It's more of like, maybe this has come too far too fast and we should start taking action. But to sort of ease any apprehension for clients, what we're doing is if a portfolio is funded with all cash, okay, and it's an all cash start, we'll take 3 to 5 months to leg them into their longer term portfolio strategy. And the point about doing that is, like, you don't, in that window of time, you won't get the high, you won't get the low, but you'll sort of get an average basis of that period of time. And maybe you can get some really good opportunity on down days to add some money. So and that makes people feel comfortable that they're going to kind of see it come together on their statements when they see their portfolios come together, and we're taking our time to do that. And it's worked. Actually, we were some new clientele that we landed in January, February at the turn of the year that were all cash beginnings. We walked into a great window of time to start deploying that, and we certainly did. On those down days that were down 1,000 points plus, we were very active and putting 10% to work or 15% to work to start building out that portfolio. And you look at those purchase gains, you look at those cost basis of those equities that we bought back then, and you look at the gains that we've had in the last 3 months. It's worked real well. So yeah, we'll continue to do that, whether the environment's stressed or not. That's sort of an approach we always lead with.
So it sounds like you have a bit of a team there. Tell us a little bit about who works with you on all this stuff.
Yeah, so I have a full support person behind me that manages a book of accounts as well, and then of course I'm part of upper management that has a say and participation in the acquisition of new business. So, full business development team. We're a team of 35 plus strong, 3 full offices. We got some of the best technology that any advisor could use. Charles Schwab is our partner on the platform custody side, and they've been great. One of the largest in the world, one of the safest in the world. And being a trust company, our way of managing money and our outlook is sort of top of the totem pole as far as risk mitigation and prudence. So, and then we have a full administration staff that I team up with on all of our accounts. So the client's fully covered with the main folks as well as the juniors behind them to support the relationship. So all intact.
Do you look at portfolio rebalancing as part of this whole process? Because somebody could have had, a certain amount of stocks and maybe it's sort of ballooned and the percentage has gotten higher. Is that part of your strategy at times?
It is. And it's funny you said that because rebalancing, we just actually went on our mid-year rebalancing venture. We just completed it. We tend to do one at the end of the year and one in the beginning or the middle of the year. So twice a year if the markets are behaving normally. It is wise to do it because in prolonged periods of up markets, you can have your initial 50-50 allocation go to 55-45 just by natural causes, right? And if you continue to leave it alone, it can even go further. You might wind up at 60-40 when your intent is to stay 50-50. So you've just naturally walked into a more risky portfolio. So you should rebalance once in a while. We wouldn't recommend too often because there's transaction costs and you may take unnecessary capital gains to do that. But enough to keep your portfolio from skewing too far out of its bounds, okay? Because when the market's going higher, well, you want to sell and take the winners off the table a little bit and rotate that back into the areas that did not work out well during that stretch of time where it was positive, because everything trades off, and if you're talking a 10-year period, whatever was a leader for a period of time will not be the leader for maybe another period of time. So, and you get better risk controls and you get better returns, average annualized returns over time if you had a prudent rebalancing strategy at play that you followed.
Okay. What's your advice for, is your advice for new clients different than clients that have been with you for years?
It's a good question. Well, everybody's different. I would say no on that, because everybody's portfolio is built to what we're trying to achieve for them. They all have different risk setups and component makeups and liquidity needs, tax constraints, what have you. Everybody's different. So that advice we give is geared towards them, okay? And we pay a lot of attention to their financial plans. And if there's any change in that original dialogue that we had that warrants our attention, it needs to be spoken about, because that may dictate a change into the portfolio. So I think, there's a little bit of an element of our advice, I say, is across the board. In other words, we just made a change in our committee right now to sort of lean a little more growth oriented versus value, because some value tends to be the place where some of the cyclical sectors tend to hide out, which we think are going to have a longer recovery period. So the portfolios might across the board have a little more growth, okay, and follow our advice there. But as far as the components that go into a portfolio or how often we trade that portfolio are all over the place and all different, and that's all client driven.
Okay. I have an audience question here.
Sure.
Which party is likely to be voted into office during an election year can also affect how stocks perform, especially as the election date approaches. Typically, when people believe the incumbent party will get elected, the market goes up. If consensus points to a new party taking over, however, the stock market tends to go down. So I guess that's sort of somebody making an observation rather than a question. So maybe what your thoughts are, if you agree with that, or maybe how we should watch what's happening in the polls and things like that.
This year's so different because we got something in the way, and it's called COVID-19. I mean, we haven't seen, if we didn't have this virus floating around, the election rhetoric would be really running as far as the press and the media. It would be, we would be paying more attention to it, but it's, we really haven't seen that. We just really haven't seen any kind of election dialogue. This year it's going to be different. The market, tries to maybe again, it's very difficult this time because we got a lot of influence by the government as far as what they're trying to do to save the economy. The market's living and dying by every media release on that front. And it's strange. The election talk's kind of taking a back seat, but that's not going to last. I mean, here we are 4 or 5 months away, and it's going to pick up. I'm not going to comment, obviously, on my beliefs personally, but the market can, if you look at history, if you have a gridlock Congress, House and Senate that are divided, it really doesn't matter who's in the seat. The market's done okay. But again, a lot depends on tax policy. It depends on regulation. And you really don't know what that environment's going to look like after the fact, whether it's an incumbent or not, right? But the market likes continuity, so maybe leaning more incumbent might be a little comfortable because things are in place. The market has been used to tax policy. We got a great corporate tax reform back in 2018 that the market has digested and we've all gotten used to now. So a lot's dependent on the policy afterwards, but it's difficult this year. It's not a normal year. We got a lot of things in the way and they're going to continue to be in the way. I mean, if we get a new wave in September, October, we have an election in November, well, how's the media going to split its duties and handle all that between what's going on with COVID and what's going on with the election situation? So it's tough to tell. It's a tough year.
It sure is. I'm going to throw it back to Clayton. Mason, it's been a pleasure interviewing you. Hope we get to meet in person sometime soon. Hopefully things will get back to normal more. So Clayton, back to you. I see we got Q&A and chat questions. So back to you.
Yeah, thank you very much. Yeah, we're loaded here with a bunch of questions. Mason, that was great. I could listen to you for another couple hours. So
Thanks.
thank you for that.
No, anytime. Appreciate it.
All right, so we've got one. You touched on this a little bit, but this is a little more of a direct question. I believe we've heard the other day that we officially are in a recession, but the Nasdaq hit an all-time high.
Yeah.
And is on the rise. Can the market maintain this level of growth, and do you see another major drop in the markets?
Yeah, it's a good question. Good questions. Yeah, it's kind of counterintuitive how you think the Nasdaq. Why would the Nasdaq reach an all-time high? Why everything is so bad on the other side of things, right? Well, like I was telling Kevin earlier in the earlier questions, is the big cap tech area, that arena, sort of all the Nasdaq. That's all it really is, and that industry didn't really suffer as much as the S&P and the Dow and small cap and mid cap. So it had a smaller drawdown. So here we are, and coming out of the recession, or coming out of the downturn, that big cap tech sector area has led the way the entire time, pretty much, with the exception of a couple of weeks. So, but markets tend to bottom before a recession is actually, or before we realize a recession is over. Okay, because the market's a forward-thinking tool. Okay, so and the second part of the question, can the market maintain this level of growth? I think this person means the velocity of the growth. I don't think so. Like I said before, I think we would kind of all welcome a pause, maybe some sideways trading for a while, maybe even a 5% give back, which wouldn't be the end of the world. It would just give it a chance to catch its breath. And I think it would be healthier because we can consolidate and not let this thing run away from us. But you know, we need some help from other parts of the market to keep this going, I would say. You know, the cyclicals, I mean, the banks are still far off their highs. Energy is still far off their highs. Pockets of industrials, materials are still off their highs. So we can't have big cap tech, the FANGs, right? Facebook, Amazon, Netflix, Google. We can't have those guys continue to be the only companies that continue to pull these markets up. So if we get a better balance, I think that'll make it a healthier next leg, you know. But at least right now, a little maybe consolidation is probably warranted.
Yeah, no, absolutely. How long can the Fed continue to boost the markets?
Well,
do we just have an endless pocketbook?
Yeah, forever. They can do it forever. Really, that's not what you want to do, but they can. I mean, there's stuff they haven't even done yet. I mean, they can go to negative rates if they want, but they're not going to go that route. That would be disastrous for and other things. I mean, and they're going to stay far away from that. I mean, they could even buy equities if they want. They've talked about it. They've never done it, but I don't think you want that kind of involvement from a government body, right? So but they can. So they can do it forever. I mean, they can keep rates at zero for as long as they want. So their next big challenge is to figure out, like they were back in 2011, 2012, when they were starting to have the conversation of pulling back. It upset the markets. Remember the taper tantrum? Rates went up over a matter of a few days because the market didn't like what they said. They got to be very careful about how they craft their language now going forward, because it's a sensitive time, okay? And they've done a lot to help things out. So our committee thinks we don't see them going anywhere for a while. It's just a matter of when.
Yeah. I hope we never get to the day when you have to pay a bank to hold your money, right?
Correct. We don't want to go there. Yeah, we don't want to go there.
Yeah. All right. Now we're looking at some different sectors. So any thoughts on specific sectors? Commercial real estate looks to be a long-term slump in this person's opinion. Construction will have a very delayed recovery. Any thoughts around that, or any other thoughts in general?
Well, I would say I'm not quite as versed in the commercial market as I am in the residential, because I'm looking for a home myself. So, and my wife is a realtor, so we're really well involved in what's going on the residential side. And I can tell you, it's tough. I mean, on the residential side, supply has dried up. I think people now are being more accommodative to letting people in their home to see their home on a open house or whatever. So that's starting to thaw out. But supply is very tight. Mortgage numbers came out today. I believe that they're up 13% year over year, which is just baffling that people are still willing to spend on their big ticket item here despite all this. So that's a good sign, you know, and that's countrywide, by the way. That's not just here in Miami. That's across the board. Construction, I don't know. I mean, every time I look out a window, I see a crane or I see a full crew building Class A property, in and around my neighborhood, in and around other neighborhoods. I don't know if it's, I don't know if that part was ever delayed, really. But if you look at real estate, what's interesting though, but you do have some things you got to pay attention to. I don't know if you saw the other day that Gap was sued by Simon Properties, which is a big mall owner, because Gap didn't pay their rent. So if you think like a big anchor tenant like Gap not paying their rent and being sued over it, that might point to some stresses in the commercial market. Okay, but overall, I mean, it's not like 08, 09 where real estate, we don't think, is going to drag us down. It's actually it's helping, believe it or not. And I think that's a good sign.
Yeah, absolutely. How are you structuring portfolios for clients who do not need current income but are focused on capital appreciation?
Well, okay, so the income, and I know, Kevin, I didn't really harp on the dividend comment you had earlier, but if your goal is capital appreciation, that means that's synonymous with taking portfolio equity risk. Okay, you got to have a certain percentage or a pretty big percentage dedicated to your portfolio to risk assets, which means the markets. And if you look at a growth portfolio over the last 60 days versus maybe a blended bond and equity portfolio or an all bond portfolio, obviously the capital appreciation portfolio has far exceeded the other two. But we recommend doing it constructively. You can get plenty of capital appreciation by diversifying your portfolio in many different areas. You don't have to go to tech. You don't have to go to the 5 or 10 names that have held up the S&P over the last 3 years. You don't have to go to those. It's just, again, and you go back to your financial plan, well, if your numbers in your financial plan say you only need 4 to 5% to make you happy, okay, and make your financial plan work, you don't really need to go and try to get 10, but maybe there's a personal preference to go achieve 10, but again, you may not need to. So it's discussions with your advisor on your plan. Look at your income drawdowns. What is the percentage actually needed to pay for all that, the percentage return? And then maybe you don't need to take as much growth focus as you may think you need to take, okay? But, if you had to make a sector bet or a theme bet, you probably want to go a little more growth over value in all the sectors in your portfolio and maybe lean a little more U.S. than you would foreign investments in your portfolio. Okay, still have foreign investments as a diversifier and a buffer, but, again, our committee thinks that the U.S. is going to come out of this first. Just because our track record's a little bit better in getting our act together with our stimulus efforts and implementing them right away, where the rest of the world tends to kind of take their cue from us, and follows along. So I would say overweight U.S. versus international and maybe a little more growth dominance in your portfolio.
Got it. So this is kind of a segue into the next question, what you were just touching on. And again, I don't want to get too granular here, but maybe you can just talk more big picture or certain sectors or industries you like. Any hot tips for industry-specific investments that you believe have big upside? And again, I'm not asking you to say, Google or, Facebook or something.
I mean, again, stick broad-based. I mean, don't try to get cute and pick 5 stocks and try to hope 4 out of 5 make it, or hit the home run. You're playing with fire there. But honestly, right now it's a little tough to kind of dig through maybe what's still on sale. I mean, if you look at the banks and energy, okay, yeah, they're on sale, but you got to be willing to be in them for a long time, But kind of the quick buck mentality, things have run up so far so fast in the last 2 months. It's really hard to pick them out. You got to do a lot of homework because the market, if you care about fundamentals and you kind of put a best guess on where earnings are going to be for the next year. The market's a little rich. It's rich. It's priced. It's got a high PE on it. But we don't know. PE is price over earnings, and that's the number that's talked about a lot. Well, we don't really know what the E is. We don't really know what earnings are. Everybody's trying to figure that out, and that's what the market's trying to figure out. So you got an overvalued market on kind of the best guesses of where earnings are going to fall. And you got, I think I may be misquoting this a little bit, but you got 90 or 95% of the S&P 500 trading above its 50-day moving average, which is just like, you know, the alarm bells go off that say it's overvalued and people are chasing this thing. So it's overbought, in other words, right? So, you know, not to get too stock specific here, but again, if you had a 3-year view, I would say you could probably lean a little more growth oriented, you know, versus value, just because if we're in a low rate environment and things are still going to be muddling along, you want companies that are growing their earnings, growing their revenues without issue. Okay. And those will probably tend to be the winners, you know, for 3 to 5 years down the road.
Got it. Yeah, it's an interesting time that we're living in right now. There's no doubt about it.
It is, yes.
So, well, we're getting close to the top of the hour. That's all the questions that I'm seeing. Is there one more?
There's a residential real estate question here at the bottom.
Did we already touch on that?
I think that's more of about it. I think the question is along the inventory lines and housing prices, and will job losses impact the foreclosure market, repo market, and auto repo market, actually. Sort of a spiral effect there. You know, so far prices here in our markets have held their ground. They have. And if anything, they've gone up a teeny bit just because of the supply problem. So, but I guess it depends on the market, right? You know, in the $1 to $3 million price tag range, probably not going to have a problem. That market's going to probably stay pretty healthy. Again, I'm not a real estate expert, but you know, there's probably areas of price ranges that might have a little bit more of an impact due to job losses. You know, and the rental market will be interesting. I mean, this is the first month where you would kind of think that it's the landlords are going to come knocking. You know, and this is could be the first tough month in the next couple months following where the rent's due, you know, so we're gonna have to kind of see what happens. I haven't seen anything current as far as industry notes on that, but you know, we kind of had the big Band-Aid given to us in March, April, May, right? And now June, July, August are coming around, and the first big kind of sugar rush of government help is starting to wean off. So more to come there. I don't really have enough detail to kind of elaborate there, but so far so good. It's healthy, at least locally in our zip codes.
It will be interesting to see what happens the rest of this year and as news continues to come out over the next several months.
Absolutely.
Well, we're going to go ahead and wrap up here. Mason, thank you so much. This has just been very, very informative. Thank you for your time. Kevin, great job as always. Liv, thanks for setting everything up. And everybody enjoy your day, and we will hopefully see everyone here soon.
Thank you, everyone. Thank you, Kevin and Clayton. Thank you.
Have a great day.